Welcome to the Free from Wall Street podcast, where we share how we have done over $200 million in real estate deals to create, preserve, and pass on generational wealth without the roller coaster ride of the stock market. If you're ready to start investing with purpose, visit freefromwallstreet.com. But for now, let's dive into this episode. Welcome back, Free from Wall Streeters. So today we're continuing the Ultimate Guide. This is part 2, Ultimate Real Estate Investing Guide. And today we're going to get into the technical side of real estate syndications. So whether you have a background in real estate investing, commercial, residential, not relevant, right? We did 10 years of residential wholesales and flips before we got into the multifamily syndication space. And there's a couple of things that you need to know about syndications that are different than any other type of deal you've been involved in. Your grandfather owned a few properties? Cool. Your dad used to flip houses for profit? Also cool. But now you're interested in approaching real estate just a little differently. Awesome. That's why we're putting this out. So it's natural to wonder about the returns, minimum investment requirements, taxes, and when it comes to real estate syndications, that's, spoiler alert, it varies. Today we're going to address these 4 technical details though, right? 1, what are the returns like? 2, what is the minimum amount I can invest? 3, can retirement funds be used to invest in syndications? And 4, what about taxes? Look, we like the details too, and honestly, it was understanding these 4 or 5 pieces of real estate syndications that made us stop flipping houses completely and shut down that side of the business to do this. So let's dive right in. Number 1, returns. As with most investment vehicles, people are always attracted and curious about the possible returns. By investing passively in a real estate syndication, you can earn 2 types of returns: cash flow and profit split, right? So cash flow returns are almost monthly or quarterly dividends. They're direct deposits or checks from the time that the deal closes until we sell the property, right? So typically a percentage of that cash flow goes to our partners, so you're making cash flow. Now, whether or not you take that cash flow or reinvest, that's for another day. But profit split returns are where we get to capture upside, right? Forced appreciation over the life of the property by increasing that net operating income, decreasing expenses, and appreciating that property over time. When we sell it, there's profit to be made, and then we share that with our investors, okay? So let's just do simple math, $100,000 investment, and you're looking at somewhere between, a 5, 6, 7% return in cash flow, right? So $5,000 to $7,000 a year in cash flow. And then when the asset is sold in a couple of years, you'll make a percentage of those returns, right? So you can target, for your investment criteria, it depends on asset class. It depends on how heavy of a lift you're doing, meaning heavy lifts. Like, is it a vacant property that needs a ton of renovations? Or is it an existing cash flowing property where you have stable returns every year and you can kind of estimate, 12 to 16% returns annually over the life cycle of that asset. So you can start to see how it adds up and compounds, right? So you're getting your yearly returns through cash flow, and then you're seeing profit upside when we sell the property, right? Which, historically, our investors are easily turning $100,000 into $160,000 every 5 years, right? Sometimes it's more, sometimes it's less, but that's kind of the average of what you can see. And there's other ones where you can, other investment vehicles or other syndications that might be showing all the way up to 18% returns per annum. Inherently, I think they probably carry a little bit more risk, like new construction or those heavy lifts that we're talking about. So really understanding your investment ethos is important. Maybe you want to have a diversification. Maybe you want some that are producing, stable 10% returns. And every once in a while you do something that's reaching for the stars and trying to get like an 18% return. Fine. Just make sure that whatever you're doing it on purpose and intentionally, okay? So number 2, minimum investment amount. The typical threshold for someone investing in a real estate syndication is $100,000. Anyone interested in investing in that level should have liquid funds beyond the investment value, meaning don't give your last $100,000 to somebody in a syndication, right? All investments carry inherent risk. So you have to look at that money as an investment, and obviously you want to grow it. But if you were losing some or all of those funds, would you be able to survive, right? That's kind of how we always look at our investment ethos. Your money's not going to be very liquid while the time that it's in the property, right? Unlike stocks and bonds where you can take it out whenever you want with a buy-sell order, real estate, you're in that deal until it sells, typically. We're starting a fund. If you're not in the investment club, make sure you sign up for our investor club so you can hear about how the fund is going to get structured. It'll add some liquidity to that opportunity. And then number 3, retirement funds. Can I invest with my retirement accounts? And the answer simply is yes. We have probably about 35% of our investors that invest through their retirement accounts, self-directed IRAs, and that's how they get kind of their feet wet with syndications. So you have to do a couple of steps, right? So if you've been at a W-2 job for 20 years, it's the only job you've ever had, then you may not be able to use those funds, right? Because those employers dictate where you can invest those funds. Now, simple way to check. Find your 401k docs and see if they allow for what they call an in-service rollover. An in-service rollover means that you're active, you're still in service, but you would like to roll over to a self-directed firm. If they allow for that, great, congratulations, you could do it. It's usually about 70% to 30% that you cannot do it this way. So how most of our folks do it is if they have left a job previously, they had an old 401k or an old IRA, and they left that job and now it's just either sitting at their old employer or they have already rolled it into a self-directed account. Now, if you move from one W-2 job to another W-2 job and you take your previous 401k and you roll it into your new employer account, you may have locked it up again. So you'll need to coordinate with the IRA custodian. Reach out to us. We work with Advanta IRA. They have a dedicated team of specialists that work with all of our clients. The one requirement is that the returns must go back to the self-directed IRA, not to your personal account. So, for example, when we send out distributions to our IRA clients, it will go to IRA number 1234 for the benefit of Stephen Libman to the custodian, not directly back to me. Okay. Tax benefits. So you don't get to do anything with your money these days with some sort of tax implications, right? Investing in real estate is no different. As a passive investor, you're a part owner in an underlying asset, which means you get a share of the tax benefits. This is what changed our world, right? Read Tax-Free Wealth by Tom Wheelwright. He's Robert Kiyosaki's CPA, and he started discussing how you can build wealth in a tax-free environment. And commercial real estate, like no other investment that I have found, offers the types of returns with the tax advantages that come from these assets. One of the largest benefits is the accelerated depreciation through cost segregation. So we get to do cost segregation studies, which is basically an expensive engineering report that says, all right, the IRS allows us to depreciate this building over so many years, but we know that the AC units aren't going to last that many years. We know that the rugs aren't going to last that many years. And you can accelerate that depreciation through what they call a cost segregation study. Owning rental property comes with the ability to depreciate that value over time. With real estate syndications, the sponsors often order a cost seg study where the expert will provide a report delegating assets eligible for accelerated depreciations. All big words aside, that basically means that you get a benefit of front-loading depreciation into the first few years of ownership instead of over a 30-year period of time, right? So it's great for a 5-year deal. You get massive tax benefits up front, and we share in that with our investors. So confidence in the technical details. Now that some of your specific questions about the technical side in a real estate syndication have been answered, you can approach your search with a deal confidently. You know that retirement funds can be used, minimum investment about $100,000, and there's potential for serious tax benefits and returns. So caveat to that, if you're investing through a tax-advantaged account like an IRA, you do not get those additional tax benefits because it's already a tax-advantaged account. Okay? If you weren't sure if you had enough liquid cash to invest, now you kind of know what the minimums are. And that varies by a sponsor, by the way. So like we have different minimums than other people. So, when you're finding your tribe and you know who you like and trust and who you want to do business with, ask them what their minimum is. Obviously, it's not a one-size-fits-all. If you didn't understand why people said you could double your money in just a few years, now you kind of see how we're doing it. With less technical questions floating around, maybe you're that much closer to becoming a confident, passive real estate investor syndicator. So, if you guys have any questions about this, always reach out to us. We love talking to you and figuring out how this might fit into your grand scheme of investments. And again, thanks for tuning in. If you're finding value from this page, I would love it if you hit the subscribe button, if you would leave us a review so that other people know that you're getting value from it. And we look forward to speaking with you soon. Thanks for listening to the Free from Wall Street podcast. If you like what you hear, leave us a rating and review and let us know what you think.